Okay, so we went about refining our costing system. How did we refine the costing system? We went through a series of very particular steps, most of which just involved relatively straightforward things. We just basically reorganized our costs a little bit. Okay, we changed up the way in which we allocate our costs. Can anyone describe to us the way in which we went about doing that? Do you have your hand up? First, we went back to our production system and we created what we call an activity list. Remember this? So an activity list is just a simple description of a production process, but broken down into small irreducible activities, each of which describes one particular step or one particular task that takes you a little bit closer to the completion of the production of the product. So a typical activity list, like I told you, runs several hundreds of pages long, and I'll try to get you I have several examples actually in my computer, so I'll try to post up an example of a realistic activity list. Okay, with the activity list that we worked with was relatively simple. It only included 6 or 7 specific activities. On top of it was a design activity, if you remember. Then there was a setup activity, and then operating the machines, cleaning the machines, maintaining them, preparing the batches for shipments, sending out the shipments, and then finally administering all the processes. There's 7 broad activities. Okay. Now, using this activity list, we go back and we refine our overhead allocation system. Okay. So the first thing that we do is we look at our pool of overhead from the simple costing, and we ask ourselves, are there any overhead costs in here that could potentially be traced directly to one of the products? Okay, and if there are any such overhead costs that you could reasonably trace directly to your simple lens and your complex lens, well, then you reclassify those overheads as direct costs. You take them out of the pool of overhead. So you shrink the pool of overhead that needs to be allocated in the first place. That's step 1. Step 2 is the most important step. You have a large heterogeneous pool of overhead costs in simple costing. Okay, what we mean by heterogeneous pool is that a pool of overhead costs that are many different types of costs sitting together in one place. What do you do with that pool? You try to break it out into a number of smaller but more focused or more homogeneous overhead cost pools, and you do that using the activity list as a guide. Okay, so basically every activity in your activity list should have a separate overhead cost pool assigned to it. So you're now going to reorganize your costs not based on what kind of cost it is, not based on rent and electricity and utilities, salaries and so on, but based on what kind of activity those costs relate to. So your design cost pool, for example, will contain all the different types of costs that relate to the activity of designing the product. So it will contain salaries of your design engineers, it will contain rent and utilities on your design facility, it will contain repair and maintenance of any design equipment, and so on. So you basically regroup your costs based on the kind of activity they relate to. So it's a very different way of looking at costs. You don't look at costs anymore based on the kind of resource that's being paid for. Now you don't look at it, you don't classify costs by whether they are rent or salaries or maintenance and so on. You classify costs based on the kind of activity they relate to. And once you have a number of these activity-based cost pools, so then now every time you have a cost pool, you need to attach an allocation base to that cost pool. Right? So in Plastum's case, they broke up their one overhead cost pool into 6 smaller activity-based cost pools. So now we need to find an allocation base for each of those 6 cost pools. But once you have an activity list, coming up with allocation bases is very simple because you simply find a way to measure each activity, and that becomes your allocation base. Okay? So in Plastum's case, they measured the design activity, for example, using the number of parts that were designed. So the more parts that were designed, the larger the design cost should be intuitively. So they picked the number of parts designed as the way to measure the design activity. The way to measure the setup activity, they picked the number of hours that the setup engineers worked on doing the batch setup. As a way to measure the shipping activity, they picked the number of, the number of shipments They pick the number of shipments. It's a way to measure the distribution activity. They pick the volume, the cubic feet that were delivered. So you simply find the best way to measure each activity, and that becomes your allocation base. Now you have 6 activity-based cost pools, 6 allocation bases. You know what to do. The math of allocation after that point is exactly the same as it is for simple costing. Okay? So we redid the overhead allocation using this new system, and we came up with these numbers that turned out to be drastically different from what they were before. Right? A simple lens cost, it turns out under the ABC system, is about $10 lower than it was under the simple costing. So definitely some difference here. But the most dramatic difference accrues to the complex lenses. The cost of each complex lens under the ABC system was about $35 more than it was under the simple costing system. So naturally, our profit margins also basically just sort of flipped almost. And it turns out that we were truly, if you accept that this information is better than the simple costing information, a true profit margin on the simple lens is closer to 21%. The true profit margin on the complex lens turned out to be closer to just 3.5%, which is almost nothing. Okay? So when we described what we were going to do, now we've gone and we've improved our costing system. We looked at the new numbers that came out of it, and our impressions of the situation now have changed completely. Right now, it sort of makes sense why the customer gave us the feedback that he gave us. Because 21%, it's difficult to evaluate these numbers, but you can tell that 21% is too high of a profit margin for what is simply a standard product. Anytime you have a standard product, you also have in the market competitors who are able to make that standard product just as well as you. Okay? So whenever you have a standard product out there, it's going to be difficult to get away with charging this kind of profit margin, because there is no reason a rational customer should buy from you rather than buy from someone else who's selling him the same product at a lower price. And that's why we're not able to sustain this price. Similarly, it also makes sense why the customer finds this to be a very attractive price, because this is a specialized product. This is a product that's difficult to make, probably needs some special kind of R&D, know-how, equipment, and all of that. Typically, when products are niche and specialized, producers tend to charge a significantly high margin for them because there's a barrier to entry into that product, right? A new competitor cannot jump into the market and start replicating that product immediately tomorrow because there's some special know-how, some special R&D that he needs to acquire. So that automatically means that anyone who's currently involved in that market, there is a barrier to entry from outside. And that barrier to entry allows you typically to get away with charging a larger profit margin that you would otherwise charge. But this is too small. It doesn't reflect the fact that such a barrier to entry exists. And so that's why this information, so that's why the case proceeded the way it did. So we talked about this briefly at the end of last class, but I want to touch on it again. So the mechanics of ABC are very simple, nothing complex, no new kind of mathematical procedure here. Right? It's very straightforward if you understand how simple costing works. The math works exactly the same once you figure out your cost pools and your activities. Now, what's important and what I want you all to focus on is understanding how to interpret the ABC information. Once you have the ABC information, what do you do with it? Okay, and how do you as managers, remember you're always putting yourself in the shoes of managers, how do you as managers make different and better decisions? Okay? And this is what your textbook calls activity-based management, or ABM, but that's just a fancy word that means making decisions using activity-based costing information. Okay? So there are 4 types of decisions that I want you all to be thinking about every time you get an ABC question. Okay, 4 broad types of decisions. Management in reality is far more complex. It can't be reduced to a standardized list of decisions. We're going to take a simple approach to and look at 4 types of decisions. The first type of decision is a pricing decision. Right? Clearly, the ABC information gives you differential information about the costs of each of your products. Clearly, you would re-strategize your pricing. You would want to revise your pricing. In the plastering example, it's pretty straightforward. You would clearly want to drop the price of your simple lens, right? In fact, you might even you might be able to match your competitor's price now. You could drop it all the way down to 53 and you could still make a profit, so you're good there. And you would also want to re-strategize the pricing for the complex lens. Right now, increasing prices is never as simple as dropping prices. If anytime you want to increase prices, you're going to do it slowly, test the market, and see how elastic demand is to any given increase in price. Okay? So clearly pricing is something that you would do differently with activity-based costing information. The second type of decision I want you to think about is product mix decisions. And product mix decisions are going to come up a lot in the next few weeks. Okay? A product mix decision is simply the result of the fact that you don't have unlimited capacity. Okay? By capacity we mean things like rent, qualified space and qualified people and so on. Okay, so anytime you want to get started with production, you need to acquire a certain amount of capacity, and you only ever have access to a finite or a limited amount of capacity in the short run. Right, in the long run, if you want, you can go out and expand your capacity, but in the short run, you're constrained to whatever it is that you have. Now, suppose you have more than one product that you know how to make. Like here, there's two products that they know how to make, which there is a demand for. You always have to make this decision of how much of my capacity do I devote to making product A, and how much of my capacity do I devote to making product B. You always have to make that decision. How do you make a product mix decision? How do you think manufacturers in real life make that kind of decision about which product to focus on? And it's going to be a function of the way the demand curve for each of those products looks, right? At the current level of production, what profit margin are you able to make? And if you were to increase your production by a little bit, how much would your profit margin drop? It's going to be based on a comparison of the way the demand curves for the two products look. And we actually investigate explicitly how to make that decision. But I hope you all agree with me that knowing this information would change your product mix decision significantly. Now, it's a little bit difficult in this example to tell exactly how your product mix decision would change. Now, if you were only using this information, suppose this information didn't exist, you only had simple costing information, well, then you might be tempted to suggest that we should focus a little bit more on the complex lens products, because the complex lens product is giving us a significant margin, right? But you would also have to investigate how large the complex lens market is. It might be that the complex lens market is not big enough to accommodate a larger production than this. So you have to know more information. But certainly, now that you have the ABC information, your view about your product mix is going to change significantly. Your more profitable product is clearly the simple lens. So someone might argue that you should focus on the simple lens because that's giving you a greater profit right now. But you could also have the argument that you should make more of the complex lenses, because what happens when you scale up production of a particular thing? When you scale up production, always your unit costs of production do what? They fall, right? And then if your unit cost of producing the complex lens fall, maybe that's a way in which you can squeeze out a little bit more profit from the complex lens. So it's a little difficult to say exactly how your decision might change, but you certainly understand that decision is going to change in some way. That's the second type. The third type of decision is decisions about cost reduction. Everyone always wants to reduce costs, right? Everyone always wants to figure out how to reduce costs. Now, your ABC system, we don't have all that detailed data up on the board this time, but your ABC system always gives you a better handle on how exactly to reduce costs, because it tells you exactly where your costs are coming from. What areas of your business are generating the most costs? Which activity is responsible for a large portion of your costs? So it allows you to focus more specifically on the part of the business where your costs are coming from, and to be able to identify how can I reduce the overall cost of my product, whereas a simple costing system doesn't give you a good way to do that. The fourth kind of decision, and actually this turns out to be the most important one in realistic settings most of the time, is what we call performance measurement decisions. Okay? What do you think performance measurement means? Yes, precisely. Performance measurement simply means trying to figure out a good set of metrics with which to evaluate the overall performance of different parts of your organization. And overall performance usually just means the result of all the decisions that your managers have been making within that part of the organization. Now, the thing you may not have realized about performance measurement is the following. Does performance measurement happen on an overall basis or at a divisional or departmental basis? When you're trying to evaluate the performance of your employee, what type of information is more useful to you? Information about the overall performance of your company as a whole, or information about the performance of each division or each department or each product? Sorry? Divisional information, right? So performance measurement always requires information at a finer level within the organization, either by department or by division or by product or even by customer and so on, because individuals and groups of individuals work only on specific departments or specific divisions. They don't work on all the aspects of the firm at the same time. And this reflects a very, very different focus of our field from financial accounting. In financial accounting, when you talk about performance, what are you talking about? You're always talking about the performance of the firm as a whole. You're talking about overall firm income, firm cash flows, firm retained earnings, and so on, right? Because that's the focus of financial accounting. Financial accounting reports on how the whole organization does to outsiders, to people outside. But when you're inside the organization and you want to evaluate how people inside it are doing, you necessarily have to focus on the smaller pieces that each person is working on. So whenever you need to evaluate performance at a departmental or a divisional level, there are two aspects to it. There are revenues at the departmental or divisional level, right? That's reasonably easy to trace because you know what products each department makes, okay? So that's reasonably easy to split out. You also need to split out costs by department or by division. Now, splitting out costs is not as straightforward as splitting out revenues. Why? Because you know that there are some costs that are indirect and which are shared across the departments or divisions. So cost allocation is really at the heart of performance measurement. Your perspective on how one department has performed relative to another can change completely depending on how you allocate your overheads. If you don't allocate your overheads properly and you end up allocating too much overhead to one department and too little to another department, well then your evaluation of the performance of those two departments can be completely skewed or completely off from what the reality is. Okay, so cost allocation is very intimately tied into performance measurement also. So having a good system in place for allocating overheads like you have here can also change the fortunes of the people who are being evaluated at each department level. Okay, so there's many more decisions that we can talk about, but I want you, anytime you're given an ABC scenario, to think specifically about these four types of decisions and to think, okay, now that I have this new information, how would I make each of these decisions differently? Okay, because that gives you a good starting point to move on to thinking about more complex, more sophisticated things. I hope the case gives you a complete understanding of ABC. That's sort of the main example that we're going to show in class. I want to talk in general now about some of the reasons for the popularity of ABC, and we started out the lesson talking about this. Now, why has ABC systems are almost ubiquitous now. You'll find only activity-based costing in any larger enterprise that you go into. Okay, and some of the reasons we already talked about. So you remember greater diversity of product line, right? Every firm is started producing more and more different types of products under the same roof. So that makes it more important to know how to allocate your overheads properly across these products, because whenever you have dissimilar products, they are going to consume dissimilar combinations of your overhead. So you need an overhead allocation system that recognizes that. Second trend over the last few years has been automation, right? And you remember we talked about what automation does. Automation reduces your direct costs and increases indirect costs. Because think about it in very simple ways. Automation is basically replacing people with machines. People are mostly a direct cost because they're costs of direct labor, right? So the costs of direct labor are going down, Machines are most of the time indirect costs because they are things like depreciation, electricity, repair and maintenance, support, an IT system to control the machine, a server room to control the IT system. So machines are mostly indirect costs. Right? So the amount of indirect costs you have in your total cost structure has also been increasing. So that makes it more important that you allocate the indirect costs properly, because we're not talking about pennies here, we're talking about huge amounts. Okay? A couple of more points that I want to mention. If you remember our discussion of job costing in chapter 4, we sort of talked about this trade-off between simplicity and accuracy. When you pool many costs together into a single overhead cost pool, what do you lose? You lose a little bit of accuracy, but what do you gain? You gain simplicity. It's a simple system. It's easy for you to manage, right? But that advantage of simplicity is not that big of a deal now, because you don't have to track all the information by hand anymore. Everything is tracked for you automatically by a computer system, right? So with the advent of computer systems, tracking many different cost pools, tracking many different activities, doing all of these calculations is sort of automatic, right? So that's sort of another reason why an ABC system is kind of the default now. The fourth, in practice, perhaps the most important, is the fact that we have more and more competition in every kind of product market. Okay, so think about that for a second. More and more competition in every kind of product market. Now, how does increasing competition affect your pricing strategy? Think of two polar extremes. Think of a very competitive industry, and then think of another version of that same industry, maybe in another country, where it's a monopoly. Okay? And try to think of how the producer's pricing strategies is going to differ across these two hypothetical versions of the same industry. When you have very little competition, like imagine a hypothetical monopoly, right? You can afford, at least in the short term or in the medium term, to have some errors in your pricing, because it doesn't matter. Well, typically the classic result is that in a monopoly you always end up getting a little bit of overpricing. Your products are not priced at the true value of the economic resources that you put into creating them, but because you have very little competition, it doesn't matter that your products are overpriced, because your customer has no alternative. Okay, so in a situation with very little competition, a pricing error, having overpricing or having underpricing is not that big of a deal, because you can sustain that. Okay, because there are no competitors to come in and swoop on your mistake and exploit your mistake. But when you have a significant degree of competition in an industry, you can't afford to have any kind of pricing error either on the upward side or on the downward side. So let's think through both situations. Suppose you're in a highly competitive market and you overprice. So that's what the Plaston people did here, right? They're in a pretty competitive market for the simple lenses and they overpriced. What ended up happening? You're going to lose market share very quickly, right? You're going to be shut out of the market. Suppose you're in a highly competitive market and you underprice. Okay? So highly competitive market and you underprice. What do you think is going to end up happening? Or there could be many things that end up happening. There's one likely sort of scenario that I want you all to think about. So when you underprice, you're going to basically be pricing at a loss, really. You're going to be pricing at lower than the value of what you put in. When you underprice in a highly competitive market, your competitors are going to in equilibrium, you always have to think about what they're going to do in order to prevent being put out of business, right? Because your competitors are not going to sit around passively and let you put them out of business, right? That's not a rational response. They're going to do something in order to prevent you putting them out of business. I want you to think about what that might be. Right. Then you might inadvertently end up starting off what we call a bidding war or a pricing war, right? And so everyone ends up dropping their prices in order to match yours. So who wins in this situation? The customer wins in this situation. So whenever whenever you have more competition as opposed to less, it's always the customer who captures more of the surplus, right? So the customer ends up winning, but at the same time, you jeopardize the ability of all of these businesses in the long term to continue in existence. Okay, because you're not capturing enough of a profit margin to allow yourself to stay in business. So in a highly competitive market, you really can't afford to have a pricing error either on the upward side or on the lower side. And we have significantly more competition in every product market today than we did before. Okay, so these are some of the reasons why the issue of costing is so much more important today, and we can't afford to have very simple costing systems anymore. Some practical issues to think about anytime you implement an ABC system. Okay, naturally, when you implement a new system, you have to think about the costs and the benefits. Now, the benefits from implementing an ABC system, I hope, are clear. Now, some of the firms are going to capture more of these benefits than others. Now, if you have a firm that produces very few products that are very similar to each other, well, this firm is not going to benefit significantly from having an ABC system because a very simple costing system might be sufficient for that kind of firm. Okay? So the benefits of introducing an ABC system are going to vary depending on what kind of firm you are. So if you look at the four points that we talked about, the more diversity you have in your product range, the more indirect costs you have, the more competition you have, the more important it is for you to have a more accurate costing system. And so the greater are going to be the benefits from introducing an ABC system. Okay? So those are from the benefit side. Now the costs are also going to vary across firms, the costs of introducing an ABC system. There are two types of costs that I want you to think about. The first kind of cost is a direct cost. It's an out-of-pocket cost that you have to pay, mainly to restructure your IT system, to restructure the way in which they capture information, the way in which they group your costs, and the way in which it does the cost allocation. So that's a direct cost. You have to reprogram your IT system. There's an indirect cost which often turns out to be more important, and that is the cost of managing the change. Okay, and by managing the change, we always mean getting the people on the ground to be comfortable with the new system, not just physically with operating the new system, but to be mentally comfortable with what the new system implies, okay, for the products and services themselves. Now think of the Plaston case and try to tell me which individual or group of individuals in the organization might be uncomfortable or opposed to the idea of introducing an activity-based costing system. Yes, which group would need to be persuaded into the transition more? Sorry? Are you just picking one at random, or what's your justification? And that's a problem? Think about your answer before you say it, okay? So which group of individuals is going to have to be persuaded into changing into an ABC system more? Right. And who's that more likely to be in this particular case? Possibly, that's one way to think about it. But if you recall, there isn't a problem with the simple lens. The only problem with the simple lens is the fact that we are pricing it too high. And if we adjust our pricing strategy for the simple lens, we'll be fine. So there's no real change that we have to implement on the ground with the simple lens. The only change is in the accounting or in the pricing for the simple lens, right? Which of the products do you think is going to need some real change on the ground in order to be made more profitable? Clearly the complex lens, right? Because right now, the complex lens, for the price that we are charging, is not being produced efficiently enough. The cost is too high, right? There's no way we can continue to make the complex lens and charge only a 3% margin on it. So let's suppose for a moment that we're not going to be able to increase the price on the complex lens, okay? What do we have to do? We have to drop the cost somehow. We have to figure out some way to cut the cost of making each complex lens. And cost cutting generally means what? It means either more trouble for the existing employees or it means fewer employees, right? It means getting rid of people. So chances are that the people involved with the complex lens are going to be at more jeopardy with the introduction of the activity-based costing system. So any change management that you do will have to be targeted or focused specifically towards that group. Okay? Any questions? Yes. Yes, because the demand curves are downward sloping.
So, if low margins do markets get smaller at unit cost or unit price goes up because, like, say, for instance, like a Ferrari, like the profit margin that manufacturers are making on Ferrari
is very high.
Is the margins are high or the?
It's typically high, yes. Because a Ferrari is a niche car. Typically, as you price, let me try to see if I can understand what you're saying. As you price higher, you're going to be going backwards on the demand curve. Your demand is going to drop. Okay, your demand is going to drop. When demand drops, production drops. You lose some economies of scale. So unit costs also go up a little bit. Okay, so it's a little difficult to say how your margin changes because you're pricing higher, but your cost per unit also goes up. So your margin might be more or might be less than what it was before. It's hard to say. You have to look at exactly what the demand curve looks like. How much does your demand drop, and how much economies of scale does that lose you? You have to look at that. Okay. Okay. So I want you guys to think about a question. Okay, and it's at the very back of your notes. So if you would please turn around. Okay, this is question 515. So think about it for a minute, and then you can discuss it with the people sitting around you if you like, and then I want to discuss. So 515, this is a controller of a retail company, okay, has just had a 50,000 request to implement an ABC system. Oh, is it not on your notes? Okay, I'll just read it out to you then. Okay, so pay attention. So the controller of a retail company, okay, has just had a $50,000 request to implement an ABC system turned down. Okay, so controller, do you know what controller means? A controller just means chief accountant usually. So the chief accountant at a retail company has put in a request to implement an activity-based costing system. Now this implementation is going to cost money. It's going to cost $50,000 to put in the new software, to bring in the experts and all of that. And he has had the request turned down, presumably by the CEO. So the CEO, in rejecting the request, says the following. Given a choice, I will always prefer a $50,000 investment in improving things that a customer will see or experience, like improving our shelves or improving our store layout. How does a customer benefit by our spending $50,000 on a supposedly better accounting system? Everyone understands the question? Yeah. Okay. So, given a choice, I will always prefer a $50,000 investment in improving things that the customer sees or experiences, like creating a better store layout or improving the window displays and so on and so forth. How does a customer benefit by our spending $50,000 on a supposedly better accounting system? Okay, write this down. It's exercise 515 in your textbook. Okay, I want you all to think about it, and I want us to talk about it on Thursday when we come back. Okay, 5:15. All right. So are you ready to do some practice now? So I put on your notes I hope I put on your notes the self-study question from your textbook. Okay. So let's work on that, and you can work in groups. Okay. So that way you are able to learn a little bit from the people around you also. So this is family supermarkets, okay? And like I said before, there are two parts to any costing question like this. There's a mechanical part where you calculate the numbers, and then there's the qualitative part where you have to think about the numbers and you have to describe what you're actually going to do with the information, okay? And both of these parts are equally important, okay? And we're going to work on both. So Family Supermarkets has decided to increase the size of its Memphis store. Now it wants information about the profitability of different product lines: soft drinks, fresh produce, and packaged food. Now, why might they be interested in this information, in product line profitability, in this particular situation? Why are they interested in product line profitability? Right, precisely. So this is an example of what we earlier called a product mix decision. So they're increasing the size of the store. That basically means increasing capacity. When you increase capacity, you want to figure out what product, which of your many products to focus on. Because it might not necessarily be optimal to give the same amount of space as you're giving right now in the new space to each of your products. You want to make an intelligent decision about that, right? So you have information here for each product line. Okay, so 3 product lines: soft drinks, fresh produce, and packaged food. With revenues for each. Now, fresh produce is by far the largest revenue producer. You also have cost of goods sold. Again, fresh produce has the highest cost of goods sold, consistent with that. And then you have a number of other pieces of data: the cost of bottles returned, the number of purchase orders placed, the number of deliveries received, hours of shelf stocking time, items sold. Okay? Now, Family Supermarkets also provides the following information for 2006. So it's giving you really an activity list. Okay? So the number of activities: returning empty bottles to the store, placing orders for purchases, physical delivery and receipt of merchandise, stocking of merchandise on the shelves, and providing assistance to customers. So it's really kind of a rudimentary activity list. Okay, so now let's look at the requirements before we analyze the activity list. So Family Supermarkets currently allocates store support costs. So store support costs is basically all costs other than cost of goods sold. Okay? Now, what do you think cost of goods sold might be in this case? What is it composed of? The cost of goods sold. This is a supermarket, remember. So they're in the business of buying things, displaying them, and then selling them to other people. So the cost of goods sold is simply the price that you as a supermarket pay to the supplier that sells you the original goods. Okay? To the farmers or to Pepsi, Coke, whatever it is. That's simply, it's a very straightforward number. Now, currently allocates support costs, which is all costs other than cost of goods sold, to product lines on the basis of the COGS of each product line. Okay? So what is this telling you? All support costs. Support cost is another word for overheads or indirect costs. So all your overheads are going to be allocated to soft drinks, fresh produce, and packaged food based on the cost of goods sold. So the allocation base for allocating your indirect costs is the cost of goods sold of each of your product lines. Okay? So calculate operating income. So allocate all your overheads on this basis. Calculate operating income in dollars and as a percentage of revenues for each product line. Okay? So go ahead and start thinking about how to do that. Soft drinks, fresh produce, packaged food. Okay. Revenues 317,400, 840,240, 483,960. Cost of goods sold 240,000, 600,000. And 360,000. Okay, so the first exercise is to implement a simple costing system. That's what they have right now, right? Because they're grouping all their overheads together and allocating them using a common allocation base, which is what's the allocation base that you're told to use? The cost of goods sold. Now, what's different about this allocation base compared to the other allocation bases you've seen before? What's different about cost of goods sold as an allocation base compared to, say, direct labor hours or direct machine hours or something like that? It's in dollars, so it's a financial number, right? As opposed to labor hours or machine hours, which are all non-financial numbers. But if for any reason you can't have a dollar number as your allocation base, there's no reason, okay? And your allocation will work exactly the same as it does even if you had a non-financial allocation base, okay? So as always, there are two ways to think about it. You could calculate an overhead allocation rate, okay, which would be your total overhead that you need to allocate, which in this case is, what, $360,000, divided by the total quantity of your allocation base, which in this case is cost of goods sold. So what's the total cost of goods sold across all three departments? Sorry? 1.2 million, right? And so what does this ratio work out to? It works out to 0.3. So what that means, really, is that you are going to allocate to each department 30 cents in overhead for every $1 of cost of goods sold that the department has. For every dollar of COGS that the soft drinks department has, you're going to allocate it how many cents in overhead? 30 cents in overhead. For every dollar of COGS that the produce department has, you're going to allocate it 30 cents in overhead, and so on and so forth. Okay? So dollar of financial allocation bases work exactly the same as non-financial allocation bases. There's no difference in the logic. Okay? You can have either a dollar number or a non-financial number as an allocation base. So don't be thrown off by the fact that this is a dollar allocation base. The second way in which you can think about it is using the proportions of the allocation base. So 1.2 million. $600,000 divided by 1.2 million. So really, the soft drinks department is going to get 20% of the total overhead. The produce is going to get 50% of the total overhead. And the packaged food is going to get 30% of the total overhead. Okay, you can think about it either using an allocation rate, or you can think about it this way. Okay, so what numbers do you get? You wind up with 72,000 in overhead allocated to the soft drinks, 180,000 in overhead allocated to the produce, and 108,000 in overhead allocated to the packaged food. So go ahead and calculate the profitability, the profits of each department in dollars, and also the profitability as a percentage. Okay? What's the profit of the soft drinks? 317,000 minus 240 minus 72,000. Okay? And similarly for each of the other things. You can use Excel on your laptops or iPads if you want. Okay, so what's the profit and profitability of soft drinks? You can work in groups. You can split up the work amongst yourselves if you want. Yes. Numbers. Are there any questions? This is a good time to ask them. Got a question? 5,400. What's the profit margin? The percentage? The percentage. 5,400 divided by 317,400. Okay, if there are any questions, it's a good time to ask. It's a good opportunity to ask them now while we're waiting for everyone to finish. Yes. This one? This one? As it has always been defined, the profit margin in dollars divided by sales revenue. Right here, 1.7%. And similarly for produce and packaged food, have the numbers, please. So 840 minus 600 minus 180. Yes. Can someone else answer that question? So the overhead cost, why do I multiply each of these proportions by 360,000? Does someone else want to answer that question? Yes. Right. So what are the overhead costs in total that we're trying to distribute across department 1, 2, and 3? 360,000. So what we're trying to do here is we're trying to use the cost of goods sold as a way to figure out what proportion of the 360,000 to give Department 1, Department 2, and Department 3. And using the COGS numbers, we came up with a 20-50-30 ratio. But it's a 20-50-30 ratio on the original 360,000, okay? All right, so fresh produce, please. 60,000. And so the margin would work out to 7.1%. And for the packaged foods, 15,960. And the margin, 3.3%. Thank you. Okay, so now we've come up with the similar information as we did in the first stage of the Plastum case. Okay, so now look at requirement 2. Are there any questions about this? About any of these steps? I'm happy to clarify. Yes. We discussed this, like we discussed during the Plastum case. Profitability is a scaled version of the profit margin. Okay, so that means profit margin divided by some measure of the size of the product or the amount of investment that you put into the product. Now, the denominator can be any number of things. It could be the revenue from each product. It could be the cost of each product. It could even be some measure of what are the total assets that you invest in the development of that product. So the profit margin percentage is defined differently in different contexts by different people. Okay, but for the purposes of this course, we're going to define it as profit margin scaled by revenues. Okay, and depending on how you define it, you understand that the interpretation of the number is also going to change, right? So here it's interpreted as for every dollar of revenues from the produce, you retain 7 cents in profit, 1.7 cents in profit, and so on. If you were to scale it by something else in the denominator, you would interpret that final percentage differently. Okay, so now let's look at part 2 of the question, which is the more important one. Now, if Family Supermarkets allocates all its support costs to product lines using an activity-based costing system, determine operating income in dollars and as a percentage of revenues of each product line. Okay, so now you're asked to implement an ABC system. Now, the question is, are you given enough information with which to implement an activity-based costing for Family Supermarkets? You have to have been, otherwise we wouldn't be asking you this question, right? So that's really what the second table is all about. If you look at the second table, you realize it's basically giving you everything you need to know to do an activity-based costing. So it basically takes that 360,000 in overhead that you allocated one go here using COGS, and it's splitting it up into how many different cost pools? 1, 2, 3, 4, 5 cost pools. Okay, so look at the first cost pool, bottle returns. The cost of returning empty bottles to the store. The total cost of bottle returns is 4,800. How is it going to be allocated? How is it going to be allocated? What does it say under cost allocation base for bottle returns? It says direct tracing to the soft drink line. So what does that mean? What does that mean? What does direct tracing to the soft drink line mean? It's going to be entirely applied to the soft drinks, not to either of the other two. So there's no allocation there. Essentially, it's 100%, 0%, right? Now look at ordering. So this is the cost of placing purchase orders. The total ordering cost is 62,400. They're going to be allocated using the number of purchase orders. Okay? How many purchase orders have you placed in total? 624. And you also know how many of those 624 were placed by each department. 144 were placed by soft drinks, 336 were placed by fresh produce, and 144 were placed by packaged food. So go ahead and allocate each cost using a combination of these two tables. Okay, you can work in groups and you can split up the work amongst yourselves if you like. ask me a question if you're stuck and you don't know what to do. So take 5 minutes. If you have a question, you can ask me. So your ordering costs are basically going to be split up like this. 52,400 that needs to be allocated, and it's going to be done based on the number of purchase orders, which is 624 in total and 144 from the soft drinks. Okay, so that's how you allocate that. Does someone want to give us a split of delivery costs, please? The proportionate split of the delivery costs. Yes, for us. Not the number, the splits. Yes. Just to make it clear to everyone what the percentage is. You can figure it out from the number that you calculated. Yes, please. The percentage splits. Yes, go ahead. 0.095. What is that as a percentage? 9.5%. How about the fresh produce? .5%, and with the packaged fruits and 20.95%. Okay, so go ahead and complete the rest yourselves. Work in groups and split up the work. So one person can do one set of overheads and another person can do another set, and you have all the numbers ready in 2 or 3 minutes. Okay. Okay, so what proportions are we working with for each of these? Self-stocking. 0.2%. That means this is 62%, and this is approximately 22%. Customer support. Customer support. What proportions are we working with? Okay, I'm going to start cold calling. Yes, you in the middle, please. Yes, the proportions, please. And this? Could you speak up, please, so that everyone can hear you? 71 point. I'm sorry, louder. Sorry? So, is that rounded up to 72 or rounded down to 71? So, that's 72%. So, that makes this approximately 20%. Okay? So, does someone have the final profitability of each product under the ABC system? So now that you have all of these numbers laid out, you go ahead and you calculate them, figure out what they are, and then you aggregate all of these numbers to come up with the total overhead allocated to each product line. Okay? Now then what do? Remember, your ultimate goal is to come up with the profit margin in dollars and in percentages. It's to come up with the profit margin in dollars and in percentages. So remember what you need to do. Put down your pencils for a moment and pay attention, please. You need to aggregate all the overheads and then add them to what? Add them back to the cost of goods sold and then deduct them, offset them from revenue. Okay? And we don't have enough time for you to do that, so I'm going to put down these numbers so that you can discuss them. The profitability of the soft drinks works out to 10.78%. The profitability of fresh produce works out to 0.6%. The profitability of packaged food works out to 8.6%. Okay? So go back home and verify what those numbers are. So go back home and verify what those numbers are, but you do that later. So right now you put down your pencils and pay attention to the discussion. So this is the mechanical part of the question. This is where you actually figure out original costs under simple costing and the revised costs under activity-based costing. Right now comes the more important exercise for you to do, which is what are you going to do with these revised numbers? Okay? What kinds of decisions would you make differently given the revised profitabilities under ABC as opposed to your evaluation of what the profitability used to be before the introduction of ABC. So remember, we talked about 4 broad things that you should think about: pricing, product mix, cost reduction, and performance evaluation. Okay? So which of those 4 decisions is more important to family supermarkets here as it's been presented in the problem? Why are they undertaking this exercise? What kind of decision are they hoping or trying to be able to make in the future that necessitates this exercise for them? Right, so product mix decision, right? Because they're expanding capacity and they want to figure out how to reallocate their focus. So how would you advise, if you were the consultants that were advising family supermarkets, what would you advise them to do in this situation with respect to the product mix of their new store or the expanded space in the current store? What would you advise them to do? Yes. Right. So that's what the numbers seem to suggest to us, right? But the reason I put up this example always is this is one of those rare situations where you might not actually want to do that. Okay? So let's push this to the hypothetical extreme. Like suppose the fresh produce were making like a 0% profit or even like a negative 1% profit, like a very, very low profit. Okay? Imagine you didn't have a new store to think about and you just had your existing store and you were trying to figure out how to reallocate your space across the products in order to make your existing store as profitable as possible. Suppose that was the problem here. Okay, and it came out that the fresh produce were very unprofitable and the other two were very profitable, and the consultants came in and recommended, okay, maximize the amount of space devoted to the soft drinks and the fresh and the packaged food and minimize the amount of space devoted to the fresh produce. So looking at the numbers, that seems like the logical thing to do, right? But are there any practical on-the-ground reasons why you might not want to do that? Any on-the-ground reasons why you might not want to do that? Based purely on the numbers, that seems like what you should do. The question is, any other sort of common sense factors that should affect your decision here? Does your hand go up? That's one factor you have to think about. Just think about how you interact with the department store. Right? And how a decision like that, to really scale down the fresh produce and to scale up everything else, might affect your interaction with the store. It's a very sort of very non-academic, and I'm asking you to give you a very like personal consumer reaction. Right. So very commonsensical fact. Right? But typically, you want a department store that you frequent, especially a neighborhood one, and this seems like a neighborhood one, to have everything under one roof. So here's an example of a situation where the numbers predict one kind of reaction, but you supplement the numbers with a sort of a qualitative understanding of what's really going on, and you might not necessarily do exactly as is required. So this is the reason why we always want to have human beings making decisions as opposed to computers. Okay? So there are two aspects to any decision making. There is the quantitative or the numerical aspect. The numerical aspects are what you have here on the board. And then there are what we call the qualitative factors. So these are factors that you can't necessarily translate into numbers and put into an analysis. But when you join the qualitative with the quantitative factors, sometimes overall it might make sense to do something else other than what the numbers strictly prescribe you to do. Okay, so the qualitative, so in this class we always focus more on the quantitative factors because this is an accounting course, we look at numerical techniques, but I don't want you to be misled into thinking that the qualitative factors are any less important. You always need to consider both. Now, I know we're running out of time, but I want to make one last point before you go. So sometimes it's a very common pricing strategy, you might be surprised to know this, to price certain products at a loss. And why you would want to do this, you price certain products at a loss in order to bring customers into the door and attract them to stay inside and then shop for other products that you're going to sell to them at a profit. So the most famous example of this is the company Gillette. You all know Gillette, right? What does it sell primarily? Shaving blades and razors, right? So there's two things that it sells. It sells the actual the razor, and then it sells the disposable blades that go on top of the razor. Now the razor itself, you'll be surprised to know, is always priced at a loss. Okay, so Gillette is making no money, is actually making a loss on the razors, but the blades that you need to put on the razors in order to actually complete the process of shaving are priced at a significant profit. So the razors are what Gillette calls a loss leader. They're loss-making products, but they're a leader in the sense that the razor is what pulled you into buying Gillette products. And the minute you have a Gillette razor, it makes sense for you to buy the Gillette blades that go on top of the razor, and those they price at a profit. Okay, so that type of pricing strategy is also